Hello, everybody. Thanks for joining me today. If you are listening to this through YouTube, I'd really appreciate it if you hit like and subscribe, as we definitely want to share this information with anyone that would find it helpful. So today I wanted to have a discussion around the bond market, some different things to pay attention to, different things to understand and to know about the current environment that we're in. And what you're looking at here up in the right-hand side is the current yields as of the end of the first quarter. So cash was yielding around 5.4%, 10-year Treasury sitting at around 4.2%, U.S. aggregate bond index at 4.9%, and U.S. corporate bonds around 5.3%. So a lot of people really are considering the use of cash as their conservative investment vehicle just based on those yields. And just want to have this discussion around things you should consider when you're making that decision for your overall investment portfolio. An interesting graph there in Exhibit 3 shows the different yields for the different rated bond investments. So for instance, here in the first quarter 2024, you can see the different colors here that represent Treasury bills in dark blue. Then you have AA, A-rated bonds, triple B, double B, and B-rated bonds. Lower the rating of the bonds, the higher yield they have to pay for that risk. But if you scan your eyes across the horizontal axis here, you can see what those same yields were back from 2012 to today. So just highlighting treasuries, for instance, you can see back in 2012, that yield was below 1%, where now that's being above 4%, certainly a different interest rate environment than we had a while back. So you can get a lot more yield for your dollar these days in the different types of bond portfolios. And if we think about investing, not necessarily for today, but for a period of time, which is really important when you do have investment portfolios, is to think of 1, 3, 5, 10-year periods or so. This graph shows the 5-year annualized total returns. Bonds is in the orange line, and the blue line represents cash. So looking at all the different 5-year periods we've had dating back to 1986, you can see the outperformance that bonds have had over cash, again, that blue line, over those 5-year periods of time. And specifically, bonds outperformed cash in 98% of rolling 5-year periods prior to 2022. So looking at the underperformance of bonds in any given 5-year period of time, on average, it's only around 0.38% because it corrects itself very quickly. Bonds tend to have a higher yield over a longer period of time. We just have been in a unique interest rate environment here as of recent, where cash has been outperforming, but we want people to consider the long-term effect of bonds over cash. This is a pretty telling graph to say over 5-year periods of time, typically better off in that bond portfolio, albeit we would certainly suggest diversified position in bonds. There's a lot of different types of bonds to invest in. If you look at different interest rate environments, we have the Federal Reserve making decisions about keeping interest rates the same, otherwise known as a pause, increasing interest rates, decreasing interest rates. And this graph shows the rate of return of bonds versus cash during pause environments, where the Federal Reserve isn't increasing or decreasing interest rates, they're keeping them steady. So if you look at past pauses like that, This shows February of 95, May of 2000, June of 2006, December of 2018. You can see the different performance of bonds over cash during those pauses. And then every one of those instances, bonds have outperformed cash to the tune of average return of 9.4% during the pause versus cash at 3.6%. If you look at the 1 year after an interest rate hike, this is showing that here during those same time frames here, average return 11.6% for bonds, 4.9% for cash. And just ultimately looking at bonds versus stocks as a diversifier, typically you're going to have down markets where bonds will help mitigate poor stock performance. So looking back, you can see 1977, 1981, 1990, 2001 and 02, 08, and so forth. You can see those were typically, or those were bad calendar years for bonds or for stocks. Back in 1977, down 7%, 1981, down 4.9%, 2000, down 9%, 02, down 22%. And in those specific environments, bonds had positive performance. It's just what's fresh on everyone's mind here recently is 2022, where stocks had a poor performance and bonds had an extremely poor performance. But again, that doesn't mean that will continue on going forward. And in this interest rate environment that we're in now, we really want to just make sure our clients are thinking about diversification, thinking about different types of bonds they can be invested in. And if there's something that we could help with, please call us at the Capital Group and we would love to assist. Hope you found this helpful and have a great day, everyone.